beginning of our discussion on Form 1120F, and by far one of the riskier returns for any CPA to prepare, a lot more so than the Form 5471. Why? The Form 5471 is an information return. The most you can do is to make a mistake in computing Subpart F income. The client owes some tax, maybe some understatement penalty, but not going to have the consequences if you blow the Form 1120S. So we're going to jump to the purpose of the form because it is such a important form. The IRS actually has a safety net built into the instructions. It's the only form that I know of. So the purpose of the form we can see here is to report the income, of course, and it talks about who must file, and there's a couple of things to look at. The corporation was engaged in a U.S. trade or business, whether or not it had U.S. source income, and huge because engaged in a business means you have an office here and you have staff here. You can still have foreign source income and have an office here. And we're going to talk about why to file this form is so important in just a moment in these instructions. Had gain or loss that is treated as such, that would be like maybe income from U.S. real property under FRIPTA, was not engaged in a trade or business, but had income that's required withholding at the source. So that is investment income, interest, dividends, and rents. And we're going to go over that separately. That's important too. Okay, the form is also required to be filed. So who must file, and then they have kind of a caveat in case you forget or they forgot. A claim for refund, okay. Claiming any other benefit or deductions, really important. And a claim that a treaty overrides. So when a treaty overrides, as most of you know, you have to file Form 8833 explaining why, and that's really important. And you just can't stress it too much because if you don't file, there's a penalty, and you can lose some of your rights if you don't file it. Other unique things with Mexico or Canada, don't get into that too much anymore, but it's possible. An agent in the United States. So an agent in the United States, that is a difficult concept, and so it's under, others that must file Form 1120F. An agent in the United States if the foreign corporation has no office or place of business in the United States when the return is due. So the foreign corporation has left the country but still has an agent. Agent could be even a related corporation under some case law. Treaty or code exemptions, once again reminding you to file the Form 8833, going to be very important. But the more important things here, the election be taxed as a foreign corporation is important, but I'm sure all of us know that, and you filed in Form 8832. But here's the important thing, protective return. So get this in the center of the screen. Not too often in the instructions, the IRS warns you, encourages you, or actually has the concept of protective return. And the reason is if a foreign corporation doesn't file its tax return within a couple of years after the year end, there's some special time extensions for extensions, but basically within 2 years, it never gets to deduct any of its operating expenses, and maybe not even expenses in determining gross profit. Never. So that's the malpractice risk for the CPA, is that the client does not think he has an office in the United States, does not think he has U.S. source, or he thinks he has an office but doesn't think he has U.S. source income. For whatever reason, the client doesn't want to file a return, doesn't want to spend the money, any of that. It is a real problem. So that is that warning. So here's the form itself. And this is a multi-part form. It has actually 3 taxes on it. It has income tax for a trade or business. It has the 30% withholding tax on investment income. The rate may be lower by treaty. Sometimes it's 15%, 10%, sometimes 0. And it has one other really nasty tax, the nastiest of them all, called the branch profit tax. And that comes from the concept of a C corporation that's privately held that doesn't make a distribution of profits. So it's a lot like our Section 531 or a accumulated earnings and profits tax. And you would actually use that concept to try to justify the amount that you have in your bank account or in other liquid assets. We're going to get to that. The first part of the form starts off pretty nice. Country of incorporation, or your name, that's pretty nice. Where you keep your books, that's nice. Location of worldwide business, that's a really hard question when you have more than one office. So I caught off and not sure what the best answer is there. Do you have an office in the United States? Really a hard question. And not for topic for this course. I do have a book out for attorneys and CPAs that actually goes into the case law where a related corporation was held to be the office of a corporation from Mexico. And there's one other case where a independent agent for a small postcard business in Canada, the independent agent was held to be the office of the Canadian. Both of these had tax treaties, which means they had more protection, and both of them lost. Then the name of the agent, the address, and the typical things you see on a corporation, other than the FIPTA, big deal here, the U.S. real property, and so you want to really keep in mind all the requirements under FIPTA they want you to. Permanent establishment is a treaty concept. Related parties from 5472, we just went over that. And then here you see the taxes. There's the line 1 is the income tax. Line 2 is the 30% tax on investment income. Line 3 is the branch profit tax. So let's kind of go through this form and go through the rest of the questions. Of course, they want to know if you're a controlled foreign corporation. And if you're a controlled foreign corporation and you have the branch profit tax, you could end up paying taxes 3 times. So the branch profit tax is really an important tax to look at. And part of the problem actually is having a foreign corporation doing business in the United States versus an LLC or some other pass-through entity. And we're going to kind of skip these questions because I'm sure all of you know them very, very well. Uncertain tax position, that's a new trend in the IRS. So they want you to know if you're doing any great tax planning and if you think it's certain or not. I'm sure all of you would think it's certain. So this is the part of the form that talks about the 30% withholding tax, interest, dividend, rents, the gross amount, the tax rate, if there's no treaty, it's 30%, the amount of tax liability. In theory, the payor has withheld this tax, and the payor has filed a Form 1042 and is giving you Form 1042S, which means all this has been paid. And if you have the Form 1042 and 1042X, you actually do not even have to file the Form 1120F if that's your only U.S. source income. This is really a great question. Is a corporation fiscally transparent in the laws of the foreign jurisdiction? That's a tax planning question. Great tax planning takes place with the different concepts and different nations of non-existing companies. That's what fiscally transparent means in the international world. It means like a single member LLC. So that's a clue to you of tax planning, and also you have to attach some information. Now we get to the part of the trade of business. A lot like the 1120, so it's not going to be anything new for you. And And this is the U.S. source activity. So officers, that means you would have an officer in the United States if this would be the case. And as you can see, it's nothing really too unusual for you. The concept behind it is very much so, because the concept of U.S. source gross receipts and foreign gross receipts is extremely sophisticated. Then the dividend deduction, we've seen this before, the tax computation for the income tax, once again, like the Form 1120, not new to any of us. Branch profit tax and tax on excess interest. Both are important, but not as important as a branch profit tax. So you're going to start off with the amount on line 29 from section 2. So let's just go back to that so that we can easily see it. And that's your taxable income. So that's kind of like you do on your corporate return. You start off with taxable income with your Schedule M1. And then there could be some adjustments with regards to earnings and profits, because keep in mind the concept of a dividend, just like with a controlled foreign corporation, is earnings and profits. It's not taxable income. It's not net income. You're going to come down to a subtotal on line 3. And that subtotal is going to be kind of the target figure that they're looking at. Your net equity at the beginning of the year, and this is going to be book value at the end of the year, and then you're going to subtract out the difference. And if the net book value has dropped below the combination of beginning book value, earnings and profits, less any net book value, the tax is going to apply. You do get a subtraction for U.S. income tax, but the tax is going to apply, and that's a 30% tax. The most important feature of this form is the balance sheet, this is where the net book value is going to be reported. Now, this is more just like a little math equation. This is tax on excess interest expense. This has to do with the way you finance your corporation, and we're going to skip it for this seminar. We're going to go over to the balance sheet. So we generally think, so we have two boxes here, worldwide or U.S. basis. And it's really important, and a lot of planning goes in here. If you do U.S. basis, you've given the IRS the perfect target, perfect bullseye to really easily compute your branch profit tax. You do worldwide, they'll have to audit you, and they don't have that much manpower. Maybe they won't audit you. Your clients could be small compared to General Electric or Google, so this is kind of the good planning one. When they look at the book value, for the branch profit tax, they're going to be homing in on, of course, cash. They're going to be homing in on liquid assets that, much like the Section 531, that are being accumulated for reasons that do not make sense other than avoiding the branch profit tax. This, of course, is a big thing here, because this is almost saying, come in, assess me the branch profit tax. Loans to shareholders, once again, a big thing here. Other investments with a little asterisk next to it, okay? Big things here. Other loans. So this is where people would try to play with this stuff. And the blueprint to determining what you can accumulate is called the Bardell formula. I'm going to have a link to that case on the PowerPoint. So when you're dealing with a foreign corporation that's doing business in the United States, two important things. One is to file a protective filing even if you don't think any tax is due, and that's going to include the branch profit tax with it. So don't just do the page 1. And then the last part is splitting the time on branch profit tax. It is a one-day test back to the balance sheet. One-day test, the last day of the year is going to be these balances, and that's what's going to come out to the IRS. So you want to, once again, have a client that thinks way in advance, surely 6 months in advance, but when you're looking to things like loans between branches, other assets, you want to be sure he's really planning out this equation, which is what accountants are great at, and that he has spent the time to justify it. So the old tax planning we used to do with C corporations, if we're as old as I am, when you have corporate minutes justifying accumulation, of course all your loans are documented by the corporate minutes. You would talk about growth and expansion. You would give the business reasons of accumulating assets. You explain why you got into some investment that's liquid, or maybe you bought some real estate, maybe you bought a home that's being used by the shareholder. And as Ken Barish knows very well, because we have read of this recent case, that can be a real big tax problem. And you want to really, really spend the time with the client. And with a foreign person, it's very hard because they are used to the concept of their laws. They don't really understand how tough the IRS can be. They've heard, but they have not experienced it. So we're going to go back to some questions and answers, and we're going to look at some of the links now on the Bardell formula.